it's pretty obvious that people are on pins and needles. Now, it is true that the Fed should not make policy based on Wall Street's every needs and all of the whining of Wall Street. But let's not forget, Jerome Powell, chairman of the Federal Reserve, sort of put this situation into place, and now he's paying the price, and so is the market. Ironically, though, investors that were hoping for Operation Twist or some other things got nothing. And we've got some guests today who actually think that was the best medicine. Anyway, the whole affair right now feels like a swan song, but it may not be, so don't panic until you watch this show because there's a lot going on with the sell-off and, as you can see, subsequent rebound. Maybe Jay Powell did the right thing after all. Maybe he should hold on to what he's doing, and maybe you should hold on to what you're doing. On that note, I want to bring in two of my favorite guests, Rob Luna, Scott Martin. And I got to tell you guys, let me start with you, Rob, because you were a little bit more bullish, I think, than Scott last time we spoke. This reaction from last week to yesterday, even today's resolve, what do you make of it?
I think it's all really healthy, actually, Charles. I mean, if you look at the moving averages, we said last week we're going to go test the 50. We did that. We saw the QQQs break below that. But you know what's happening, Charles? If you look at some of the stocks, and we said this, you're going to have your leading stocks, your Facebook, Amazon, went down to that 200 today, bounced off that. And if you look at that, that's when the market turned around. I think this is all really healthy. We need to wash out those weak hands in order to see that next move up.
I have it in Hey Vision. So Scott, you've been a lot more conservative, if you will, about the market. And I know, it's interesting because we go up usually in the stair steps and we come down in the elevator, and that's when a guy like you will say, hey, you got to pay attention to those elevator rides sometimes. So what are you feeling right now about the way the market's reacted, particularly to interest rates? Okay, 1.62% on the 10-year, still not the worst thing in the world.
Not at all. And it's surprising, Charles, to see the market react so terribly to that because we knew this was coming. I mean, maybe it came a little faster and, say, furiouser, if I may, than it was expected to be. But this isn't a terrible thing. I mean, rates going up, rates normalizing, maybe a little inflation should be good for stocks. And I agree with Rob's point. I mean, if you look at even beyond some of those big cap techs out there, Charles, I mean, look at the Twilios, the Snowflakes, the PayPals, the Squares, the Teladocs, the Zooms. I could go on. I mean, there's a host of them. I mean, there's a few dozen out there that have totally reversed today and bounced. I mean, I haven't seen opportunity in tech like this since I was prom king in the 90s. That should tell you something.
Yeah, and that's when everybody was excited about the calculator, right? They had like 5 windows. So that was a long time ago, my man. The Commodore computer was reigning back then. All right, so let's talk about then the changes in portfolios, right? Scott pointed it out. People are being opportunistic. By the way, being opportunistic, buying dips, has only worked since 2009. Rob, have you made any changes today or in the last couple of sessions?
No, we've been, and I know you hate this, Charles, using the barbell, but let's give people actionable strategies.
No.
Look at the aristocrat index, though, Charles. It's been helping people. And you beat me up, rightfully so, about Chevron last year. But look, that paid off. We bought the dips on that. But what we're doing now, we're holding on to that Chevron position. But now it's time to reload on some of these tech names. Like Scott said, PayPal, Zooms. These are long-term winners. You don't get opportunities like this a lot. We like those names right here.
Here's the thing, though, and listen, I'm in oil. I'm in there big, and I've been talking about the commodity super cycle. In fact, pounding the table on it, but now you've got this interesting thing. Oil also getting a help from OPEC, so it's a little bit of a different story. But back to these potential opportunities, Scott. For someone like you who has been relatively cautious, it's obvious you were waiting your time. So what about this inflation scare? Is this overdone? I mean, yeah, of course we know there's going to be some inflation, but is there enough to derail all of the amazing powder we've got from household spending to corporations to the jobs report this morning? I mean, to me, that should be a bigger macro story.
Yeah, the powder's going to be fine. And, everybody's freaked about inflation. Maybe going to what? I don't know, 2.5%, 3%? Oh, my goodness. I mean, that's so scary. When if you look in past decades when inflation was a real problem, I mean, you're pushing double digits in some cases, especially overseas. So, I mean, that's not a concern. That's actually good inflation. In fact, as the economy reopens, Charles, and maybe, hopefully, I mean, God willing, we pull away from all this crazy stimulus we're getting, which I think the market is telling you we don't really need. I mean, that's why rates, in my opinion, are going up so much. Maybe a little inflation could go actually a long way to kind of reinflate weight stocks a bit because they're going to need a kick once we're done with this stimulus and things like that. So with respect to the inflation expectations, keep them coming as long as they don't go crazy. And 3% inflation, if we get it, isn't that bad.
Yeah.
You know, I always tell people we love when our paychecks inflate. We love when the value of our home inflates. We love when the value of our Tom Brady rookie card inflates. So there's not, all inflation is not a four-letter word, right, Rob?
No, it's true. I mean, Scott's right on with that. I mean, we need some inflation, but you know what the next worry is, right? Once we get this economy set, we're setting the stage for a huge rally. It's taxes, it's regulation. Once you start hearing about that 40% long-term capital gains rate, that's going to be our next worry that we're going to have to overcome.
Well, I'm hoping that's like November, December. So it could be a long time. So both of you guys, before I let you go, then, do you see new market highs? And we've pulled back. Will, Scott, we see new highs in the market, and will it be led by big tech?
Yes, I believe we will, Charles, and we're going to get some help, as Rob said, from energy and industrials and some financials, too, which have not been there. See, that's the cool thing that I think that's happening with the market so far, let's say this year, and as we've been waiting, like you said, Charles, to kind of put more money to work here on these pullbacks. We're starting to get other areas of the market. And yes, I know they're smaller than tech. I get it. You can save the emails to me on that. Healthcare as well. But you're starting to get some help from other areas of the market that have completely lagged in the last couple, say, years. And that will help the overall breadth of the market stay strong long term here this year.
Gentlemen, I got to leave it there. You are two of the best. I feel so much strong. I feel strong like bull after talking to you guys.
Had to start it out, man.
Thank you both very much. Have a great weekend.
Thanks, guys.
That's what the barbell approach is. All right, so most of the market's anxiety really, let's be honest, revolves around technology stocks, especially those really big tech names that carried this market for a couple of years. Here's the thing, though. They really started to stall back in September, but now it's really amazing to hear market maven after market maven say, we're bailing out. FANG is over. We're out of big tech. I think these names have become more attractive, but I'm not the expert on them. I'm going to bring her in right now from Needham, their senior internet analyst, Laura Martin. Laura, first of all, I want to tell you right up front, you are one of the best tech analysts on the street. I love anytime you speak, I stop what I'm doing and I listen. Now, you have generally been bullish on the tech sector. You've already been on record saying the next 4 years are going to be bullish. So do you stick to that call?
I do. I think they're defensive. They're highly liquid. They're de facto monopolists. Most would say the dominant player, but I'm going to call it out as what it is. They are monopolies in the businesses they each created. Apple has a monopoly on the 15% wealthiest people on earth, including China. It's the only big tech in China. Amazon, in my opinion, lead competitor in e-commerce, Google in search, and Facebook in social media. These are de facto monopolists who dominate the economics in their silo.
What do you make, then, of all these analysts? I mean, you know, this sort of crowd, when they all kind of abandon ship, right? Sell Apple and find yourself a good hand tool maker. You know, I mean, listen, I know stocks can have their day, right? We know that. Any stock can come on at any time. But to abandon these stocks, to me, seems nuts.
You know, I think it's the reopen trade. I think it's fast money. So when I talk about monopolists, maybe they were beneficiaries of stimulus during 2020. So their rise may not be as large in 2021. So people were selling them because they're liquid to exercise the reopen trade. But what people are forgetting over a 3-year frame fundamentally is that what COVID did for consumers is accelerate the path to digital goods and services. So we saw Disney Plus adoption through the roof. Netflix, what happens next is the hardware installed base and the habits don't go away. So forever things will be more digital. And Google, Amazon, and Facebook are all digital fangs.
You made a great call on social media. You said wait until after the election. After the election, all they've done was catch fire. I mean, Twitter, the move there, Facebook and its resolve, Snap. You still like the social media names?
Yeah, I like what Snap's doing best. I'm very worried about regulatory for Facebook, and I'm very worried about defections from Big Blue Facebook, which they sort of keep track of for us every quarter. So I prefer Snap and what it's doing from its $10 billion base of market cap to Facebook.
All right. Hey, Laura, that's all the time we have. I really appreciate you coming on. Like I said, you're one of the best, and we really needed you today more than any other day. So have a great weekend.